CNBC senior markets commentator and overtime co-anchor Mike Santoli. So we'll lean on his market expertise through the next 60 minutes as well. It's great to have all of you here with us today as we take a look at, Joe, what's a very, very interesting market day as we've turned a bit. Nasdaq is now green, as is the Russell. So the Dow and the S&P obviously are well off their worst levels, and we're watching a number of different asset classes, from oil, of course, to the metals, et cetera. What are your thoughts here?
So I think you have to ask, what is the message in the price action that we're seeing today? And I truly believe that the market did a very efficient job in pricing in a premium over the last month for energy prices and for bonds. And for whatever reason, certainly equities were discounted over the last month. So that puts you in a position today where what could be perceived as a significant geopolitical shock that acts as a catalyst for a precipitous decline in risk assets is not unfolding. And we're kind of just back to where we were last week, understanding where the opportunities potentially might exist in the marketplace. I also think it's interesting that it is the Mag 7 that once again are coming to the rescue on a day like today. It is Apple, it is Nvidia moving higher, it's Microsoft, it's Alphabet. So if there is ultimately an equity safe haven, those names once again prove themselves to be exactly that.
The commentary, Mike Santoli, I'll come to you here just to lean on you for a moment, seems to be anything from
slightly in the red today as well. It actually would be their worst day in about a month, and maybe that's, I don't know, a good sign. Or maybe it comes as concerns about America's supply of missile interceptors crop up. Capital Alpha Partners says those fears are being realized as Iranian missiles are impacting Israel. And there are reports the U.S. is relocating missile defense units from South Korea. If American assets are pulled, analysts warn that allies will have to reduce their dependency on the U.S., diversify suppliers, maybe even build their own capacity. My next guest says those concerns are partly driving today's market action. Joining me here on set is Michelle Crusoe Cabrera, the CEO of MCC Global Enterprises and a CNBC contributor. It's great to see you.
Good to be here.
So it is a bit odd that we have a market that at least this morning was, let's not call it a panic, extremely concerned about what's going on. And yet the defense names are selling off a little bit. And so just kind of explain what you think is going on.
So there's a huge difference between today and yesterday, right? The market seemed to take everything yesterday in stride, and now things are very different. I think that has to do with the report that you just said. So I think there's two reasons. First, Iran clearly sees this as an existential threat. The regime does. And like a cornered animal, they're going to do everything they can to survive. So what have they done? They've attacked their neighbors. But Bill asked, why would you attack your neighbors? It's not that they're attacking their neighbors. They are going after the energy supply for the entire world. They want the cost of this war to be very, very high. So they're cutting off supply in any way they can. And the second reason related to that are there are assertions, unproven at this point, that they have many, many more drones than perhaps originally expected. And one of those drones, if they are successful at perhaps taking out
Anthropic will, quote, probably be its last investment there, too, also ahead of an expected IPO. The era of NVIDIA writing these massive checks to the AI labs, its supplies may be coming to an end, and the public markets are about to take over. Scott.
All right, Christina, thanks. We'll see you in a little bit. That's Christina Partsenevelos. For more, let's bring in Kate Rooney for what all of this means for OpenAI and for Anthropic, for that matter. What do we take from Jensen's comments?
Scott, I think what Christina mentioned about the IPOs is key here. So these companies going public, I have heard from investors and sources leading up to that funding round, as we sort of got the drip of news, that it was the last dance for these companies before they do go public. So when Jensen Huang says, it's our last opportunity, it is his last opportunity. It's a lot of investors' last opportunity. And that's why you saw so much demand for some of these companies in private markets, because it was marketed that way. And it was sort of your last chance to get in at these private valuations. There's also a question this late in the game, if that's a good investment, depending on where they end up in an IPO. But I think that's some of the context that's really important here. That $100 billion that we saw last year came with a ton of caveats, too. So it was really tied up in certain compute targets. So they needed to deploy a certain amount of gigawatts. What Christina said, too, getting it pulled forward in a $30 billion lump sum, according to the companies, made more sense, because if you're public in a year, that's going to take multiple years to drag out. So the company is sort of framing this as this was actually a smoother way to just get more capital quicker and really fulfill some of the needs they need.
Financials are another opportunity there. So I think there's lots of spots that people can go in, do their own work, and buy some individual names that have been unjustly, let's say, sold off and where fundamentals aren't meeting the actual reality that the stock is trading today.
We'll get through a bunch of the different sector moves because they are interesting today. I love the context that you put, and at times like this, context is more important than anything. The S&P's down 0.2% on the year. So we've run a lot and we've gone nowhere. What do we do as we look at the backdrop, what's happening geopolitically, and we realize that the story at home is still good? And until that changes, why would you react to something so far away, even as serious as it is?
So if you're asking me, should you panic and go jump headfirst into it?
No, I'm not asking you if you should panic.
No, of course not. Of course
that wasn't
okay.
the question.
So
whether you should panic.
Okay, I misinterpreted. Of course, the market looks forward. The market has been through its share of wars and skirmishes and geopolitical events, and generally, if you look a few months later, generally, it's calmed down and something has reverted back to at whatever level we were previously. So this is another example where we have sort of an explosion, literally and figuratively, that the market goes into some sort of oh my God phase. But here we are, and it's a few days later.
We will take you to the markets. We're weak, obviously, across the board, off the worst levels, but nonetheless, you do have almost 1% or more declines for everything, clearly, but the Nasdaq, which is about 0.75%. I mentioned what's really, Steve, driving the action today. The jobs miss, the oil, gas prices are up. Qatar warning that the war could shut down production from the region, drive oil to $150 a barrel. B of A says only persistent oil spikes really matter. The VIX at 28 earlier today. What's on your mind as we wrap up what's been a pretty turbulent and down week?
Yeah. So look, this is a daily occurrence. We start out on the lows, the overnight futures really at the bottom, and then we get buyers, bargain hunters coming in or short covering. And I don't see that changing anytime soon, except for the fact that I have to believe the president is looking at this as he does. He pays attention to the market, pays attention to the polls, and saying, maybe we got to get out of here sooner. Now, oil and jobs are an issue because even if when they shut in the oil, meaning production, because the silos, the tanks are filled, it takes a while to start it up. So you could see an extended inflationary bump. So the question then becomes, does the Fed look through it? And I don't know about that, except for the fact that the job numbers were so bad, they're going to have to look through it. But again, that's 1 month. We're basically zero over the last 2 months. So what I believe is this market's a lot different. I was thinking about the 1970s when you had the oil shock.
Yep.
At the same time, you had low